Imagine a roller coaster ride that everyone's watching, but no one knows when it's going to make that significant drop. That's exactly what's happening with federal interest rates right now, because we're diving deep into why the Fed keeps rates flat and what that looming future hike could mean for you. The Federal Reserve had another chance to put the brakes on our speeding economy, but guess what? They skipped it. Yep, they've kept the base interest rate steady for the 12th time in their year-plus crusade against rising prices. So, what's the magic number? The Fed's key rate is between 5.25% and 5.50%, and it's been chilling there since this past July, which is actually the highest it's been since all the way back in 2001. Throwback, anyone? As a result, rates could still climb higher in the coming months. The Fed's got its eyes on the prize, aiming to push inflation down to a 2% yearly rate. So don't get too cozy, your wallet might still feel the squeeze down the line. So guess what, team? The committee's binoculars are still searching for signs to help them tweak monetary policy. Their recent words are an encore to their July meeting, like a classic song you can't get out of your head. They're asking, how much more must we tighten the belt to bring inflation back to that golden 2%? To answer that million-dollar question, they're looking at past moves. What is the lag time for policy effects? And how has the financial landscape shifted? As for the market pros, most saw this pause button moment coming. It's like a timeout for the central bank, giving them room to breathe and assess. They want to see if those rate hikes they've been dishing out since March 2022 have tamed the inflation beast. Plus, they're curious about the side effects. How much those higher rates have rocked the boat for loans and the broader economy. What does that mean for you? So your loans will pinch a bit more with higher rates. But hold on, there's a silver lining. Your savings accounts are going to look a lot healthier too. For instance, certificate of deposit rates are nudging close to a whopping 6%, a number we haven't seen in a hot minute. Don't expect those loan rates to ease up anytime soon. We're talking maybe next year. But here's a pro tip from Robert Frick over at Navy Federal Credit Union. You can lock in these high rates on things like CDs or even government bills. And get this, locking in around 5% means you're outpacing inflation. So if inflation does what most experts think it will, drop, you'll be sitting even prettier next year. When the Fed hikes its fund rates, what happens? You guessed it, mortgages, credit cards, and business loans all start costing you more. It's like the Fed's saying, whoa, slow down there, spender. They want to keep supply and demand balanced and wages from skyrocketing. And, oh boy, these hikes aren't just pocket change, they have real consequences. Businesses find it tougher to bring new people on board. And if you were dreaming of that new car or finally buying a house, you might have to pinch those pennies a little harder. So, at this point, you must be wondering who the winners and losers are from the Fed's latest decision. But before looking at the statistics, I have a short announcement for you. If you enjoyed this video, please press the thumbs up button and subscribe to this channel for more updates. Let's reveal the anticipated outcome: savings accounts and certificates of deposits. So, since the Fed decided not to hike rates this time, most banks are like, cool, we'll hold off on boosting rates for savings and money market accounts. But some are still being cheeky, offering a little extra AP to lure you in. If you're stashing your cash in the right spots, you're golden. Online savings accounts and top-notch CDs are still going to give you bang for your buck, even if the Fed sits on their hands. Plus, you'll be out-earning inflation, and who doesn't want that? Looking to max out your interest earnings? Well, you may want to go digital or cozy up to a solid credit union. They often outperform your run-of-the-mill banks when it comes to rates. Already snagged a rate on a CD? Nice. You'll keep raking in those yields for the term, unless you're ready to cough up a fee to break it early. And if you're thinking, rates might be peaking soon, then it could be a killer time to lock in longer-term CD, like 2 to 5 years, while the getting's good. Mortgage rates are actually BFFs with the 10-year Treasury yield, not so much the federal funds rate. But guess what? They often end up doing the same dance moves for similar reasons. Lately, that 10-year yield has been climbing, and you better believe mortgage rates are joining the party, still sitting pretty high. Year over year, mortgages are costing you a whole lot more than they did last year. Combine that with the insane price tags on homes lately, and getting those house keys is like a financial game of Twister. No wonder the housing market's starting to cool off, right? Now, let's chat about HELOCs, home equity lines of credit. These bad boys usually march to the beat of the federal funds rate, so expect them to stay steady. If you're eyeing the prime rate that banks offer their VIP customers, know that it usually tags along with HELOCs. Got an existing home equity loan? Rates probably won't budge much, but it might still be an excellent moment to scout out a sweeter deal. Stock and bond investors. Remember when the Fed's rates were hovering near zero? Man, the stock market was like a party that wouldn't stop. drop. Low rates made stocks the belle of the ball, way more attractive than bonds and those slow and steady CDs. Traders are now giving stocks the cold shoulder thanks to the 10-year Treasury yield hitting a year-long high. If rates keep soaring, we could see corporate profits take a nosedive, or, even scarier, a full-on recession. Switching gears to bonds, they're feeling the rate hikes big time. The longer the bond, the more complex the hit, but don't lose hope. The bond market's been tamed because everyone's betting the Fed's about to chill on the rate hikes. Looking to get into bonds? Now's the right time. And hey, if rates decide to play nice and drop, bond buyers will laugh at the bank. As for stocks, let's fasten your seatbelts. Need a financial haven in the meantime? Short-term rates are still your go-to. Credit cards. Do you know those cards with flexible rates? They're hitched to the prime rate, like the federal funds rate's twin sibling. So, the Fed's latest move, or non-move, means your card rates stay put for now. But don't pop the champagne just yet. We're already dealing with sky-high rates, especially after the Fed turned up the heat earlier, so what's the game plan? Prioritize paying off that gnarly high-interest debt like it's a VIP on your to-do list? Check out some of those 0% or other low-rate balance transfer offers for a head start. Honestly, card rates won't bug you much if you keep that balance at zero. With all this stuff, there are future hiking possibilities. So, you know that feeling when you're at a BBQ and the skies are clear, but there's that one ominous cloud lurking? Yeah, that's what the future rate hike feels like right now. It's not here yet, but don't get too comfy. Experts are saying it's still a possibility. Factors like stubborn inflation and what's going down in the job market could be the catalysts. Inflation's been throwing a party lately, but it's starting to wind down. Even so, the Fed decided to hold off on hiking rates further. And what does that mean for you, savvy savers? It's time to get selective and snag the best deals on savings accounts and CDs. If you're eyeballing credit cards, scope out a killer balance transfer deal. And if you're into CDs, locking in longer rates now could be a smooth move. And there you have it, folks. It's like we're in a financial thriller, isn't it? Rates stay put for now, but don't let that lull you into a false sense of security. The Fed tells us, don't get too cozy. We're keeping our options open. It's the Wall Street version of a cliffhanger. So, what's the takeaway here? Stay vigilant, make those intelligent money moves, and watch the horizon for what the Fed does next. Whether you're a saver, a spender, or somewhere in between, your choices now could set the stage for your financial future. If you found this information helpful, or if you're just a fan of suspense in the financial world, go ahead and hit that like button. Subscribe for more updates.